And welcome everybody to another Smart Money Circle interview. I'm Adam Sarhan. With me today is a very special guest, Bob Fehrmann of Fehrmann Capital Management. At its peak, Bob managed over $11 billion in assets under management. And Bob is an expert on growth stocks and growth investing. I am very delighted to have Bob on the show today. And without further ado, Bob, the floor is yours. Thank you so much.
All right. Well, thank you, Adam. I'm not sure I'm an expert, even though I've been at it for, which is hard to believe, almost 50 years now. So, but I never would consider myself an expert.
That's a true sign of an expert. If somebody came on and said they're an expert, then they've got an issue.
Every morning when I fire up my computer, I let the market tell me the story, and it sometimes surprises me every day. So I'm always learning.
I love it. Well, Bob, I always like to ask, can you tell us your story and how you got started in the business?
Sure. I'll do it two ways, if I may, Adam. I've been interested in growth stocks probably since I can remember, maybe 7 or 8 years old. And I grew up, I was born in 1951, so I just turned 70. But I grew up in an era where there was all kinds of new companies. I mean, maybe it was the first or second McDonald's was built like 4 or 5 miles from where I was growing. So I got to see all that kind of growth. I grew up with Kodak and Polaroid and Xerox. I grew up in an era where, there were no computers, no cell phones. So I was always interested in companies that were just rapidly growing. And so I was always inquisitive as a little boy asking questions. But to kind of advance that, when I entered college, I went to a big university here in the Midwest. I went on a football scholarship. After my first year, things didn't really work out with me thinking I was going to be a professional football player. I quickly realized that the little world that I grew up in, the world was much bigger once I got out into that universe. So my folks were middle class. My great-great-grandfather were immigrants from Germany, and so I was a family of farmers. So I was the first one that was going to go to college. So when I gave up the scholarship, my folks were a little displeased with me, to say the least. So I found a private school in Chicago, DePaul University, that would let me play in the golf team, no scholarship. But they said they could help me get a job. So I'm now 19 years old. I'm in the business school placement office looking for anything that I could do because most of the classes were over before noon. So I had the whole afternoon to make a living and help pay for the tuition. So I went through the placement office, Adam, and I found the one that had the highest hourly rate, and that was $2.25. And that's how I got started in the business. I happened to work for a firm that was the leading investment banking firm in the Midwest. They were getting started in the investment management business. So I was just a 19-year-old boy, and they took me on, and I was like a sponge. Anything they wanted me to do, I would do. But I did well enough so that when I finally graduated at the end of 1972, they took me on as a full-time employee. And so that's kind of how I really got started in a business, more accidentally. But the firm was all growth-oriented, looking for companies that were somewhat startups, but more mid-size and growing. But part of the story, at least from an educational standpoint, my first day of work was January 2nd, 1973. And for the first, if my memory's right, maybe 5 or 6 days, the market was up. And then I had to live through 2 years of a 50% decline. So it taught me several lessons. And in those days, all I've ever done is institutional. So I've never done any retail-oriented clients. So by institutions, they were pension funds, endowments, union, profit-sharing funds back in those days. And so we always had to be pretty much fully invested, and they just wanted our best ideas, and they hired us for a specific goal, which was to find growth stocks that were growing and hopefully making money. So I learned that that there's a time that you want to participate in the market, and there's a time that you really don't want to participate, or if you can, go to the sidelines. But at the end of that, and so we had 2 years pretty much of straight down markets. But I also learned that when markets begin to bottom, there are some really great opportunities. So it taught me two things. One, that you can get out of the way. And then probably more importantly is that once the market decides to bottom, there are some really great opportunities and a tremendous amount of wealth can be created at the bottom. And so that's really what I've been doing for almost 50 years now.
Wow, what a great story. So when you were
All by accident. It
I
also taught me, Adam, that to kind of keep an open mind and let things come into your life. Where I've seen people, if you get too rigid, both on your views and what you let and who you let into your life, a lot of times you just miss opportunities.
got it. So I guess, Bob, my next question is, tell us a little about your investment strategy. You like growth stocks, and there's a time to be in the market, time not to be in, like Livermore says, go fishing. How do you determine when's a good time to be in, when's a good time not to be in? And if you could speak to your investment strategy, please.
Sure. And when we obviously were growth, but we were looking probably more in the, I would probably say mid-size companies. Excuse me. It's early in the morning. It keeps me going with my tea. But we wanted companies that were growing rapidly. So by rapidly, we were looking for companies that were growing 25% or more annually. And the other thing, I didn't learn this in the first firm. I learned this from my partners when we started the second firm, which were they're probably the two best stock pickers I've known even to this day. We were looking for companies. We wanted to find the best companies in that environment. But more importantly, we wanted to be growing faster than what investors thought that they could grow. And so we created really we were kind of early in what was called momentum surprise. So if you looked at an earnings grid, we wanted companies that were growing. So they had year over year earnings growth on an up and down axis. But more importantly to us, because we figured out that if a company can do more than all the investors, I'll say Wall Street as a generic sense, thought that they could do, that they would have rising stock prices that were growing faster than the market. So we captured what we called earnings surprise. And so that was finding the best companies. And if you could keep them long enough while they keep quarter after quarter beating expectations, you would outperform.
I love that.
So our internal, even to this day, my objective is to try to double my money every 3 to 5 years. So you need somewhere between a 14 to 25% return. And we were able to do that for 15 years in a row at almost 25% a year.
Well, that's a standing ovation.
Yeah, good. But I also, to try to stay somewhat humble, I also, this period when we started the firm was from 85. So from 1980, say to 84-ish, through the year 2000, just the S&P 500 went up 14 times in that environment. Yeah. So it was a wonderful environment to start a firm, and it was a wonderful time to also be a growth investor.
Yeah, Buffett talks about that, and he calls it the Great American Tailwind, right? So he looks for just participate in that over time.
Yeah. Mm-hmm.
So, Bob, let's talk about that strategy for a second. So, earnings surprises. You look on an annualized basis, not quarter, or do you look at?
No, we did it quarter by quarter, and we did it several ways. Well, first of all, on an axis. So you wanted year-over-year earnings growth. And then quarter to quarter, we were able to capture surprise. So if a company was supposed to earn $1 and it earned $1.10, that would be a 10% surprise. Or if the street estimate was $1 and it actually earned $1. So we could graph that. And it did a couple things for us, Adam, is if you were looking at a graph, too bad I didn't have one today, but if you look in the upper right-hand quadrant, those would had the biggest momentum and the fastest growth. But over time, you could see how companies would kind of circle through that. So that when we had an environment where growth was not in favor, you could begin to see the cyclicals. They would be down here with negative growth, negative surprise, and then they would start as the economy picked up or whatever environment we were moving through, they would begin to move through there. So even though we were growth manager at times, we were able to begin to move out of the higher growth as they began to not meet expectations and move into some of the cyclicals. And so that's kind of how we did that.
That's extremely interesting. So it's not just growth stocks. You'd actually shift over to other areas of the markets that were, I guess, lagging at one point in time, but they're emerging. in
But
what
they're emerging. Yeah, like it's even like in today's environment, after the pandemic, you're beginning to see those. If I grafted for you, you could begin to see they were losers, meaning that they were losing money and they
Yep.
were negatively surprising the analysts because they just weren't able to keep up. But you're beginning to see some of those companies move along the lower left and move into the upper right.
Energy stocks and exactly industrial. I got you 100%. So that's exactly what I was going to ask. But okay, thank you for answering.
Yeah,
So
no, that's what we did. Now there's to this day, I don't participate too much in the energy group. We used to always call it was too slippery for us. Um, and
I like
it's,
that.
commodities have always been a difficult thing. So most of the time we were not really into energy.
Got it. So that was my next question. So would you have sectors that you would just avoid because of enter any reason you want, even if they exhibited growth surprises, you'd still stay away?
When we did the firm, yes, we did. We pretty much would go through those.
Mhm.
But there was never what I would say a real heavy bias in terms of those cyclical areas, but it was enough to create some defensiveness.
Okay.
Because on the institutional side, most of the time they would not let you go to cash. I mean, we had to fight like the Dickens to get clients just to let us go to 25% cash because we always believed. See, the environment I grew up, nobody believed that you could market time.
Okay.
And institutions probably to this day still don't believe that you can market time.
Right.
Now, when I talk about market time, I'm not talking about day to day or week to week.
Understood.
You could, the moving averages. If you use a 200-day moving average, there's times where you can exit, or just not participate or add any new money to it. So since we weren't able to do that, we had to come up with some way to participate in what we would call lagging industries, which we would historically wouldn't do much with, and then move money to that area.
That was my question. If you had to be always invested at all times, when you said there's times not to be invested, how'd you handle that with respect to positioning the portfolio and client management or expectation management, I guess would be the better question.
Well, it was probably easier than you think, because just think if you're at that time, IBM was one of our clients, and they gave us $100 million to manage, but they had a $3 billion pension fund.
Right.
And so when we would go to discuss with them that we were, the markets were starting to roll over and we wanted to kind of lighten up, their view was don't worry about it. We hired you for 3 to 5 years to do your thing.
Okay.
And from an overall portfolio management, they took care of their risk. So we were the aggressive growth piece for a small piece. They would have a value manager and they would have a bond manager and a real estate manager. And so that's how they took care of the risk. So they really didn't care. If the markets were down 25, they didn't care. They wanted us to be down less than 25.
Right.
But if the markets were down 25 and we were down 21, they thought we did a great job.
Well, yeah, of course, because that's your mandate, right? So I get that. And they have a long enough view where they don't get shaken out because it's a 1 down day or 2 down days or any of that nonsense. Yeah. That's really, really enlightening. Okay, so
and for me, that was a valuable lesson that their time frames were longer, because for what I do today, I probably hang on to stuff much more longer than most of my associates or friends do. But it taught me that if you really got a great company, the business is still sound and the fundamentals, you're going to have some drawdowns, but you don't necessarily have to get rid of the whole position or try to find a way to get back in it.
Yeah, I love that, Bob. I have a thing called time arbitrage, where arbitrage is the difference between two things. And time arbitrage, most people are staring at the intraday charts. They forget the forest, and they're not even looking at the trees. They're looking at the leaves on the trees. But when you step back and you look at your ideas to capture the forest or the great American tailwind or the bulk of the move, you have to step back. I love that.
Yeah. No, for what I do, at least for the last 15 years that I've just been on my own, Adam, I pretty much just use weekly and mostly monthly charts. If I have something and it's worked and I have a great return, I really fight like the Dickens not to get rid of it.
Not to look at the dailies.
I don't want to say mislead you that I don't look at it, but in terms of making actual, say, sell decisions, I pretty much just use a monthly chart.
Monthly charts. So that's very interesting. I tend to prefer those longer time frames as well, weeklies and monthlies. Can you speak to that a little bit? I know most people
Yeah,
want
well,
to.
when I say that's for maybe a long-term holding where I might have a 50, 100, 200% gain. Because those kind, unless, as long as the fundamentals really haven't changed, I just don't want to get rid of those because I think they're going to just continue. Because I still have 4 or 5 stocks today, Adam, that I bought in that 2009, 2011 period.
Wow.
And, I may work around the core position and push the size up. But there's been no reason for me to sell them.
Right.
Sometimes they get testy. So when I'm looking at a monthly, I'm really looking at, if you're using moving averages at 1224.
Sorry, Bob, can you say that again? Say those are moving averages again, please.
Yeah, the moving averages I'll use on a monthly chart are 12 months, 18 months, and 36 months.
And 36. Nice. So 1 year, year and a half, 3
I'm
years.
using that to make a sell decision. It's ones that I've had big gains in.
The cushion. Yeah.
Yeah, I mean, but some of those, I have, just take Apple Computer, I got a 25 times cushion. Okay. So I can live through a 30% drawdown, when you're up 20 times on it.
Yeah, no question. So that's really good. And then how about from entry? I know that you're very big on risk management. So can you speak about risk management, how you handle risk, and then
Sure.
from entry, what you tolerate and all that fun stuff?
Yeah, if you were to analyze and look at my turnover, most of my turnovers all in the beginning. So when I enter something, I run a real tight ship on my entry. I don't like to lose. If I buy something today and it's down 3 to 8%, somewhere in that range, depending on the environment, and I'll exit it. Okay. So the long-term charts and the long-term strategy is really for the ones that are working. So my losses are, say, on average, probably 5 to 6%.
From entry. From entry.
Sorry?
From entry, not from peak equity.
From entry, yeah, from entry, yeah.
Right.
Yeah, that for what I do, that's the key, is just to keep those losses as small as possible. But now you have to give the stock some room to breathe. Otherwise, you're just going to get stopped out all the time.
Yeah.
But in the beginning, it's real tight. But once they start moving, I just get much, I'll use the word relaxed. It's not that you're relaxed, but I mean, I'm still watching it. But I give it much more room. Once I'm up 15, 20%, I'll give it much more room. Now, I'll set a stop where I at least get out at break even once I get that kind of gain.
That was my next question. Do you raise the stop to break it? So let's say you enter a position, you put this 3 to 8% or 5 to 8% stop below the entry point, and then it starts going up. When do you move the stop to break even? 15, 20% gain?
Usually once it gets close to 10.
Okay, 10.
Usually once I get close to 10, it's, particularly if you've got any kind of size in there.
Yeah.
Even at 10, I don't like to give too much away because the business is hard enough as it is.
Seriously.
Because you don't get those 100% winners or 20-time winners. It takes a lot of time for that. Yeah. So if I'm up about 10, I would say on average, I'll set the stop at break even.
And then what's next? The next catalyst in your mind? If you're up 30, you'd move it back up, or would you just watch the weeklies and monthly moving averages at that point?
Just at that point, I probably don't. I won't have any automatic stops on it. It'll be more manual, or I'll look at it. But at that point, I usually will wait to the end of the week before I sell, unless there's something that really, it has to be some catastrophic event for me to sell interweek. Because I just, I've been on the other side of the business, the institutional side, and I know how we used to make decisions and how our trader would make decisions. And Friday's a day where you kind of want to settle things up and figure out what you want or what you don't want.
Yeah, I agree. All my stuff is done on Fridays, and if not over the weekend when the markets are closed. Yeah. Okay.
Yeah, so I made, like most people, I've made all those mistakes too, where I'll sell on a Monday afternoon, and Friday I'm sitting there saying, why did I do that?
It's crazy.
I just gave up a company that I wanted to own for all kinds of time.
So how do you handle that? That's a really good point, Bob. Just random small movements on Monday, Tuesday, it doesn't look good, but by Friday, the weekly bar looks great. Do you not set hard stops? Are they mental stops, or do you just
mental stops at that point? The only time I set hard stops is on the entry when I first buying a position. Yep.
So if it's going against you and you have pain, so to speak, in the first half of the week, you might acknowledge that that's a normal thing and not get jittered or hyper react or any of that kind of nonsense. You just stay
Right.
relaxed, stay calm, cool, and collected, and understand, like Dalio says, it's another one of those, right? This
Right.
happens many times, and then wait to the end of the week to make a decision.
Yep, I'll make the decision, or I'll adjust the position size if it's something I want.
Take some of that heat off or that pressure off.
Yeah, that's what I'll do. Yeah, but I will normally. Well, let's see. How do I want to say this? Usually, it all depends on where I am in the environment. That's why I'm struggling with how to say this at the moment. If let's say we're coming out of a correction, I love to buy stuff that, it looks like a bottom. I never know if a bottom's being formed, but it begins to round out. But if something's coming up, let's say if I'm looking at a daily chart, if it's starting to come up through the 200, and it's a stock that I like and the fundamentals are there, yeah, I'll enter. I'm not waiting for breakouts or beyond resistance. So I'll enter on the 200 day, and if it gets above the 50 day, I'll enter. So by the time a stock might get through a shelf or an actual breakout, I should be pretty close to having a 10 to 15% position by that time. So I like to enter real early. I kind of call it, once it's coming up through the 50 day, I may start with a 5, 200. If it gets through the 50 day, I'll add a 5. And then if it gets through most of the resistance, I'll do another 5, and then I stop.
So 5 meaning 5% of
5%,
the actual position that you wanted.
Yeah.
Got it. So yeah, I haven't, my investment system is called AMPD, AMPD, and A stands for advanced or early entry points. So I smell what you're cooking, so to speak, about not just buying breakouts, try to buy early and,
yeah. And that's what I learned as an institutional manager, because we were the ones creating, not just our firm, but all the firms that were doing similar things. We were the ones creating the bottom. So when I went on my own, I said, well, why do I want to wait for breakouts?
Right.
Because I'll go let it go up here. That's what we used to do.
Yeah, I learned that also.
Yeah, you posted on Twitter. Hopefully you don't mind me.
Yeah, go ahead.
That Edwards, I think it was Edwards, wasn't it? EW.
Yeah, with the downward trend line and then the breakout below it. Yeah.
Yeah, but it was a perfect example. I didn't do that one, so I missed that one. But you saw that when it came through to 200 and it had pretty good volume, and went through to 50, had pretty good volume, and now it's up. And so it's probably up, what, 10 to 15% if you just would have taken those first 2 earlier entries.
Yeah, I posted that I have a members area called findleadingstocks.com, and it was given to members right there. And those are the type of charts that I try to get people to just break the pattern, interrupt their pattern, because most people are taught to only buy breakouts. But like you, from the institutional world, I learned they're building the base, right? So why we wait? And when you buy only the breakout up here, you've got the risk reward isn't ideal, because where are you going to exit if you're buying up here? If it just negates the breakout, which most breakouts fail anyway, you're going to get tagged, lose money, and the stock's still fine. And then to add insult to injury, it goes up without you. So I just had to.
Yeah, particularly since 2009, 2010, when QE started, for me, that kind of got me more away from the breakouts. Yeah. And it's just like, with the pandemic last year, you get these V shapes. And so by the time it gets to a breakout, if you would have entered on these early moving averages, I mean, that's 15, 20, 30%. Well, you're going to get selling up there. I mean, if you were fortunate to enter and you got 15, 30%, you're going to probably peel up a little bit of it. And so that's why I think a lot of breakouts don't work. I mean, not as well as they used to.
Yeah, I wanted to ask you about that.
In the 80s and the 90s, particularly in the 90s, particularly the last half of the 90s, I mean, breakouts was the way to go. You could just breakouts on new highs. You just could load up and they would all work. No, I shouldn't say they all, but 80% of them would work out. How
about in the 70s? I was going to ask you, do you notice the market change over the decades? And have you adjusted your strategy or approach to be in harmony with the market? Or is it all the same, just human nature?
Yeah, most of it is human nature. I mean, things have changed, obviously, and they move a little bit, well, not a little bit, they move much faster today. And the technology, I mean, when we were doing that, remember, we didn't have computers or iPhones or alerts.
Right.
Our research was, you call up Weyerhaeuser and how many trees are you planting in the forest today and stuff like that. Where today you can relatively economically, if you can't get it for free, you can get it, fairly cheap to get that kind of information. So that's, in some ways, it's become much easier
To access the information, but the
to get the
actual,
information.
yeah, understood. So, but before I shift to the other topic, Bob, psychology for me is really, really big. I've got a book called Psychological Analysis coming out soon. Can you speak a little bit about the top 1%, what makes successful traders, their psychology, the smart money, if you will, and anything to that world? Like, I'll stop at that.
Yeah, I think, because the mechanics of what I do, or a lot of people that do similar things, or traders in general, can really be taught in relatively short order. I mean, the folks I teach, just the mechanics, I mean, I could teach most of it in an afternoon, to be quite honest.
Yeah.
But it's how you handle it is the thing. So I think the mind is extremely important. In fact, I think there's three things. I call it the physical, the mental, and the spiritual. And you got to have all three of those in line. And so when you come into your office, you want to be, I call it certainty. And the certainty comes from understanding your philosophy and implementing your rules. And for my routine, I wish I would have known this when I was younger. I probably was 40. Where I watch my food intake. I work with a health coach for the physical aspect, and then the mental aspect is meditation. For me, is what's worked.
That's interesting.
If you don't have those, it gets real. Now you can create some mechanics by not getting oversized positions where you can't sleep at night. I think if people make mistakes, it's they either use too much leverage, or the position size are just way too big. Because I bet you it's been, I don't think I've used leverage since 2008 or 9.
Oh, wow.
Yeah, I'll be 100% invested through, through those markets. But for me, there's just been no need to really leverage up. And when I was an institutional manager, you couldn't leverage, you couldn't short, you couldn't do anything other than just buy long and hang on for the ride and go through the rotation. So I do not use leverage. So for me, that helps keeps the emotional stuff. And so I can ride through, when I say I had a few stocks that I've owned since the 2009-11 period.
Yep.
Those probably never got to more than a 15 to 20% position at their peak. So when they pulled back 35, I probably there's one or two that I let it go down almost 50% and I didn't pull the trigger.
And they've rebounded.
And they rebounded. Yeah.
Many times over.
Many times over. Yeah.
And now that 50% is from the peak equity, not from entry.
Yeah, it's not. Yeah, no. Yeah, that's why I said before, where most of my turnover and my time is really spent on the entry. It's not. I'm not going to lose 50% of my money.
Yeah, no, 100%. So, okay, I love that. So let's break that down, unpack that for a little bit. The physical stuff is watch what you eat and stay active and move instead of just sitting on the chair all day doing this. That's huge. And I think it's a tremendously understated or underappreciated part of investing and trading, because it's a sedentary job. We just sit all day and do this. It's just, you got to, move. The mental and spiritual, my goodness, I mean, that's right up my alley. So for the meditation, Bob, can you speak, do you do TM, like Transcendental Meditation, or do you have your own practices? Or how do you?
Well, there's a couple. I was fortunate, it had to be maybe 88 or 89. I was sitting on an airplane and all of a sudden I got interested in taking care of my body and health. So I'm reading these books, and there's a fellow, at those days, we were doing well enough that I was in first class. This is before we did privates and all that kind of stuff. And it was an Eastern Indian guy that was sitting next to me, and we were started yakking. He said, "Oh, you don't need to really do all that stuff." And his name was Deepak Chopra. I don't know if you know that name.
Of course, he sat next to you.
Yeah, well, it turns out we became friends, and I helped him with his foundation. Our families went to India together, so he was the one that taught me meditation.
Oh, wow.
and taught me. He was the one that really got me all into the spiritual aspect of investing and, you know, emotional control.
Wow.
We
So
were,
what?
a funny little story. We were at an airport, probably early 90s, and so early 90s. I would have been in early 40s. And you know how you get airline delays, and we got an announcement that our plane was going to be canceled, and I was up there, and you know I was kind of acting like an idiot, to be honest,
Hothead. Yep.
and demanding. And he pulled me aside. He said, "No, you don't really need to do that." And then I said, "Well, I'm just a little frustrated."
Yeah.
And so he said, "Well, you know, you don't have to go that far back in history. Where if you wanted to go from the East Coast to the West Coast, I don't know if you heard the story before."
No, I haven't, but go ahead.
Oh, okay.
Yeah.
If we want to go from the East Coast to the West Coast, you'd go by stagecoach, and it would take you about 6 months. Most of the passengers would either get killed by the Indians or they get some kind of disease. So he said, "Bob, what are you worried about an hour or two here? We're going to make it there."
Right. It's so true. It's putting things in perspective and stepping back. So that's amazing. I had no idea that you knew Deepak, or you know Deepak, and you've worked with him for so many years. So what are some lessons you've learned on that front, if you don't mind sharing, that you wish you would have learned at a younger age for the audience to benefit from?
Yeah, you know, that's where I learned meditation. And meditation, you know, for those that have not done it, it's nothing mystique. It's, you know, it's really just trying to calm your body and really to get your mind to focus on one thing. I mean, if your mind's like my mind, it's, you know, it's racing all day. It's talking to myself all the time. It's like, you know, who's all this chatter up there?
Right.
So it's really just kind of sitting still. I usually do between 30 and 45 minutes in the morning and 30, 45 minutes in the afternoon. And for those that don't, the simple technique is just to close your eyes, sit in a comfortable position, and just follow your breath. So you just close your eyes, you just follow your breath, and thoughts are going to enter. So the objective isn't necessarily to wipe out all thoughts. It's just to get it to focus on one thing and be calm to do that. But you know, today, Adam, with YouTube, and there's just so much stuff. I mean, if somebody really wants to learn to meditate, but a walk in the park would be good, or walk in nature. Anything that kind of gets you just to kind of calm down, put things into perspective.
I love that. I always say it's control, right? So for me, when I learned about meditation, all that kind of fun stuff, it was difficult.
You meditate?
I do, yes. And my brain would work, like say, like you, or just like a ping pong ball going crazy, right?
Mm-hmm.
So, or Tasmanian devil is how my wife talks about it.
Yeah.
She's like, you know, it's going boom, boom, boom. So I always tell people
it still does that.
It still does that. That's the whole point, right? So for me, the way I internalize it, it's about control, right? So it's binary. It's real simple. Are you in control of your mind, or is your mind in control of you? And for most people, they think they're in control of their mind, but then I ask the question, can you stop thinking? And I pause. And then for like a split second, they stop thinking. But then within 30 seconds, 10 seconds, each person's different, 5 seconds, the mind starts racing again. So I asked him, I said, okay, well, if you can't control your mind, then by definition, your mind is controlling you. That's okay if your mind is trained, but your mind isn't trained. So why would you want an untrained Tasmanian devil, or enter any other cartoon character you want, controlling you and interfering with your ability to move forward? So to me, that's just it's an exercise. Like you want to sit up, like do sit-ups for a flat stomach. This is the mental sit-ups or something along those lines.
Yep. Yeah, that's the mental aspect. And it helps keep things in perspective. It keeps you more relaxed. It keeps your blood pressure at a more normal rate. But like I said, walks in nature are good too. For those that really want to get into it, might be a little esoteric, is to try to do 24 to 48 hours in total silence. You don't talk to anybody.
Wow.
I used to try to do once or twice a year. Now I kind of do it once a year. I miss it. We're fortunate we have a home in northern Michigan, so it's part of a national park. But what I pretty much do it once a year. I'll go up there all by myself. I don't even bring the dogs, because you know, otherwise I'm yakking with the dogs, because somebody's got to listen to me talk.
Right.
And you sit there and you walk in nature, no computers, no phones, no nothing. It's just you. my energy level when I'm done with that, I call it my little retreat. I mean, it just goes through the roof. Even my complexion gets better. I mean, when I do that for 2 days, I usually will eat 2 apples a day and maybe 1 or 2 Diet Cokes. The Diet Cokes I probably should get rid of, but that's all I do. So I'm also cleansing my system at the same time.
Wow, that's fantastic.
Yeah, I mean, my whole body just like it comes alive again.
Wow.
But my mind is it just gets clear. We used to have a saying that if you're looking for magic and you're looking for answers, it's really in the silence.
Yes.
That you create. It's not in all the chatter. So when you get to that point where your mind is totally silent, that's when everything can enter.
You know, it's funny, not all, but the vast majority of uber successful people are very big on meditation. You've got Dalio does it, Seinfeld does it, you know, Howard Stern does it, all these guys that are like top level, and there's hundreds of others. But at first it was foreign. It was like, why would I want to stop my mind from thinking? I thought the whole point of my life is to think. But then but
my biggest mistakes have been made when I'm thinking.
Me too. When you understand that you're okay, there's the monkey brain or the subconscious, and there's a conscious mind, right? So there's nothing wrong with thinking if you can control the thinking. The problem is when you're not in control of the thinking, and that's where you go off the deep end, so to speak. Okay, that's fantastic. So in the spiritual stuff,
but for your viewers, it's nothing mystique, and it's not a religious, you know, some people have a misconception that it's either mystique or it's, you know, Buddhism or whatever words you want to put on it. But if I would give your listener, forget about whatever investment style or time frames, whatever you want to use, I can pretty much assure everybody would be much more successful if they can figure out how to control their mind. And for me, it's worked through meditation. I've tried other techniques. I don't know if you're familiar with Wim Hof.
No, I'm not.
Yeah, he's got a breathing technique. He's called the Iceman. He's the one that cold showers and, you know, cold will create your mitochondria will fire it up, which is really your energy system. So there's other methodologies and things to do, but I found that one to be the most successful. So.
It's one of those things, Bob, where I'll give a challenge to you. I'll give a challenge to the audience. I'll give you $1 million cash right now if you can tell me what the color blue looks like. Or what does chocolate taste like? I'll make it 2 million.
Yeah.
Can't do it. You literally can't do it, right? It's something so simple. But once you see blue, I mean, here, this thing's blue right here. You know it's blue, but you have to physically see. Once you taste chocolate, I can't give you a vanilla and be like, this is chocolate. You know it's, but you have to experience it, right? So it's the same quality here there's certain qualities of life where you have to experience them to know them. You literally can't use words to do justice to describe chocolate sweet. Well, so is honey sweet. Is that chocolate, you know? So it's the power, that the result of the silence and the quieting of the mind. Taking control is the easiest way to do it. And for people that don't understand it to understand it, it's just taking control of your mind. It's just that simple.
And getting your mind to focus on one thing at a time. And
you're in control of that focus.
When you're coming into your office and you're focused on whatever it is, if you're trying to look at a chart or investment, you don't want your mind thinking about, all right, well, what time am I going to have lunch? Or
exactly. That's the practical standpoint.
You want to be laser focused for whatever you're attempting to do or whatever your career is.
I love that. So it's just increase, like, because one of our mutual friends, Jim Ropel, has a great line. He says, you know, anyone can scan for RS stocks with high EPS ratings or relative strength ratings. That doesn't take a genius, especially in today's day and age where you've got an abundance of information and access to anything at your fingertips. It's how you use the information that separates the winners, so to speak, from everybody else. Mm-hmm. And this is the part of the conversation that really gets me excited because most people don't talk about this. And this is the mindset, the mental side.
Yeah, the mind and taking care of your body, and so that you come in focused and your energy levels up. But that also creates certainty because, you know, if you can do those things and you also have your methodology down, you know, when you come in, if you have certainty, you can get through all these pullbacks and bear markets and all kinds of stuff.
So let's talk about that for a minute. When you've been in the market for decades and you've seen bull markets, you started in a bear market. What better way of getting training besides going in there with the bullets flying?
Tell me the importance of protecting what you got. That's for sure.
So when you see it's another one of those, like Dalio talks about how history just repeats itself over and over again in different ways. It rhymes. But how do you anticipate market action? Like after you get in, there's only three things a stock can do. It can go up, down, or sideways. So do you plan for those three scenarios and remove the emotions from it? Or do you say, hey, listen, we're overdue for a pullback. The market's too extended above the 50 or whatever the case may be, or oversold and due to bounce. I mean, can you speak to that a little bit as far as looking
Yeah,
to the right of the chart?
I'd say for the most part, I let price take me out of the action, so I'm not really anticipating. Now, when things get really extended, I like to sell stuff into strength and almost buy weakness. It might be the opposite of what the IBD people sometimes do. It's not a good or bad. Just my methodology. And remember, there's a lot of ways that people can make money doing this. This is just the way that I do it, and it's worked for me. But normally I wait for a break of the moving average unless we get really, really extended, and then I'll start peeling stuff off. So I try not to anticipate. For my past, when I anticipated, Adam, I would always leave money on the table.
Okay. That's really good point. And then which moving averages do you use? You mentioned the monthlies. Do you wait for the monthlies to break, or do you wait for the 50s?
No, well, it all depends on how extended things are. I mean, because if you look at the monthlies, if you look at some today, I mean, they might be 30. There's one I have that's 70% above the 18-month moving average. Well, I'm not stupid enough to give that kind of stuff back. So I would say, well, on the dailies, I just have the 50 and the 200. Those are only two moving averages I have on my charts. No other shorter term ones. Just the 50 and the 200. And on the weekly, it's the 10-week and the 40-week. And then on the monthlies, it's typically the 12, 18, and I'll say 36.
So do you start selling when the market's going down, like breaks a 50, for example, or breaks a 200? Do you start selling when it breaks a 50, or do you just wait until the longer term moving average?
Well, I'll take some off when it's extended. But most of my sales will be what breaks of, say, the 50 and 200.
Got it.
Now, I may not sell at all.
You will not sell it all. Sorry, you will sell
I
it all?
may not sell at all.
You may not sell it all. Okay.
Yeah. The folks I taught, the challenging part here is you really where my conviction comes is I really understand the company, and this comes from my institutional days when I used to do research. Is if I really understand the company and they're implementing their business plan and they're exceeding expectations, and it's just because the market wants to take it down, I usually will not exit the whole position. I'll hang on to it.
Okay.
Because even like the ones like Apple and Amazon and a couple others that I've had through that 09-11 period, I mean, I've scaled those back and moved them up. Because a lot of those, they had 40, 50% corrections in there. So I don't want to say I had a 20% position in Amazon and I lived through a 50% correction. That's not correct. I lived through taking it down to a 5% position and lived through it.
And then scale back up as it goes back up. Yeah. Got it. That makes perfect sense. So
Bob, I missed some of them, but I tend to do that.
Yeah, we can't catch them all. There's no question. Okay, a few questions, just portfolio management. So when you initiate a position and you've got confidence and you've got clarity and all that fun stuff, what size do you typically open up a position with? Is it 10%? Is it 18? Is it 20? Is it 5?
No, if we're coming out of a correction, say, or a bear correction, and we're working our way through, I usually start with like 2 to 2.5% positions.
So if you have $100,000, you'd invest 2,000 or 3,000 in that portfolio.
I'm sorry, what was the size?
If you have $100,000 portfolio, you put 2% of it to work. So you put $2,000.
$2,000, yeah, to start. Yeah.
And
I try to keep the risk small and the losses small, because I don't, if I'm buying something that's, like the example with EW, that when it's coming up, even though it's got some volume through the 200, a lot of those fail. Okay. Right. So I don't want to go, hog wild in there. So and this comes also back from the training as an institutional, we could never go more than 5% in a position.
Okay.
From cost, yeah. Now that with clients, we were able to convince clients that because market appreciation would take it up to an 8, but usually when we got to 8, they would demand that we would take some off the table, which never made sense to me because
Right.
you got a winner. Why do you want me to sell the winner and go and buy some other loser? Not necessarily a loser, but something that's not doing it
Right.
well. So no, I'll start small relative to what some folks do, and then build it up.
Got it.
And I'll build it pretty quickly if it works.
That was my next question. How big would the max be, and then how do you get there?
Oh, I think today the max for me is maybe 20%.
Okay. And then how fast would you get there? Is it 2% chunks every time until you get to 20, or is it 5% chunks? Or
if it's moving pretty quick, like the example you used, if I would have done that one, I probably would be a full 15% at this point. Pretty quick.
Got it. Okay.
Once it starts working, I'm pretty quick.
You scale hard. Got it. Okay. And then just the last few questions.
Can I mention one thing?
Yeah.
When I'm also, even like today, I keep my buy list real small, probably compared to most people. To this day, I probably don't have 30 names on my list.
Wow.
That's it. Now I'll run the screens like everybody else, and I'll add and subtract once in a while. But I'm trying to just really focus on what I consider to really be the best and outstanding businesses that are really growing as rapidly. So I keep it small. And a lot of times through a market cycle, Adam, I'm just using those 25, 30 names and just going through them.
So that's really interesting. What criteria do you look for individual stocks? Is it fundamental? Is it technical? Is it a combination of both? Or
well, I start just with the fundamentals. So I get the list of stuff that I really want to own, and then at that point I go see if there's a appropriate buy point where I can limit the risk on the entry to buy it. And if it's extended, I'll keep it on that 20 because everything pulls back. I mean, nearly everything pulls back. So I'll keep it on the list. But I work with a real small list of names, and for me that works.
That's awesome. Yeah, that's what I meant by anticipating earlier, where you said everything pulls back. So like something's extended, you're not going to chase it. You're just going to wait and let it pull back.
I rarely chase.
Yeah. Okay.
Every time I've attempted to do that, that's exactly when it pulls back. And then that's hard. It's just particularly if something's 15% above the 50-day line. I'm not going to give it 15%. I mean, so why buy something that's hanging up here and just give it my 3 or 5 or 8? I'm just going to get stopped out, 9 out of 10 times. So
doesn't make any sense.
Yeah, I just won't do that.
Okay. Final
but
question.
For me, the times I love to really get involved and invest is after a correction.
Yeah, me too.
Yeah.
It's the best.
Yeah.
Now, after a correction and or after a bear market, right? Or any kind of line. Yeah. So, okay, Bob, this is awesome. I guess
will do. Well, go ahead.
No, by all means, please.
No, I was going to say the other thing that in today's world, I will also use ETFs.
Okay.
All right, because in the market that we're in now, the indexes are doing well, but I haven't been able to find much that I would feel like putting new money to work.
Yeah.
More or less just kind of managing my existing positions.
Right.
So I would probably be, well, I am underexposed for what IBD would call a confirmed uptrend. Gotcha. So I'll use an ETF. I'll just buy the Qs and just kind of load up on that just so I keep some market exposure in an uptrend.
Got it.
Because if I didn't have an ETF, I would probably only be 35%, 40% in right now. Got it.
That's really, really powerful. So, okay.
But I haven't found anything to buy, but the indices want to perform, they want to do their thing. So I just said, all right, I'll jump on the indexes.
Yeah, no, that's a very smart way to do it.
Yeah. I have two sons that let me manage their money. They're both in the financial business. So they always have to get pre-approval.
Okay.
And then they have to hold it for 60 days before I can do anything with it.
Oh, wow.
Yeah. So that's what kind of got me interested in ETFs in the first place. Because I said, well, how am I going to do this? Because, I don't want to buy something and I have to wait 60 days. Because what, 60 days, I think can be cut in half.
Seriously.
And then I got 2 angry sons at me.
I
So
love
for
that.
some of your viewers, I wouldn't be bashful about using ETFs. In fact, the folks that I've worked with over the, probably say last 10 years, the newer ones where this is completely new to, I encourage them to start with ETFs. And then, because you can live through most of those movements unless it's just a really, really ugly market. Or buying an individual stock, if it moves against you, they panic right away.
I couldn't agree with you more. I think that's a very, very good piece of advice for new traders, especially in growth stocks. But I guess, Bob, to wrap up, what would be the best piece of advice you give your 30-year-old self, or a younger version of yourself, when it comes to life or markets or anything in between?
I wish 30 years, that was like 40 years ago for me.
Your 20-year-old self. How about when you started at 19? How about that?
Well, in terms of the investing, would be just to be patient, and don't be too quick. Because I think it was when I was a youngster, 30, I would say still kind of a youngster, kind of more in a hurry. You want to make money fast as you can. So I would just slow it down a little bit into patience. And then the other thing that are not investments are the things we talked about that I wish I would have known more about, the mental and the physical and the spiritual aspect of just the human body, because that will not only make you a better human being, it'll make you a better investor, in my view.
100% agree. Well, Bob, this is fantastic. I want to thank you so much for your time today. It's been about an hour, so thank you kindly for being generous with your time. What's the best place or way for people to get in touch with you?
Well, I am on Twitter. It's RFEHRM. I do not post too much about markets on there, Adam. If people want to message me, I'll be happy to answer any questions. I'm always just reluctant of throwing stock ideas out there, because there's two sides of the equation. You got to buy, and then if I could just sit there and tell people, I think this looks good and it's setting up, and yeah, I bought it. I feel guilty if I didn't tell people that a year later or 6 months or 2 months later. I've been burned in my professional career by giving somebody a stock tip that went up 5 times, and then a year later I run into him and I sold it. And he, this individual, and he was the chairman of the finance committee of one of our largest clients. So he was not a happy camper, because he bought it at 10. It ran up to maybe 42, and the next annual pension meeting we had, it was probably down to 5, and then went to bankruptcy.
Oh,
so
my
he
goodness.
was like, well, "Why didn't you tell me?"
Right.
And I said, "Well, you just asked for the stock tip. I didn't know I was managing your money, that money."
Right. Exactly. Seriously.
So I'm always reluctant, but to answer your question, I don't mind answering questions, but I'm kind of reluctant to give individual stock.
Good way to do it. It's a very good way. Well, Bob, as
I
always,
don't think they learn that way. We talked about it with your videos. Sometimes when people are just looking for the ideas, they don't really get the process. And I think too many people, if they just buy something, they have no idea what they're doing and not sell it, they're just going to lose money.
You're absolutely right.
My email address, I can give you my email address, or if you have any.
Well, no, the Twitter's fine. If you want people to get a hold of you on Twitter, that's perfect. Yeah, no, that works out perfect. So I can't thank you enough, Bob. This has been an absolute pleasure.
And hopefully we'll speak again. Yeah, I'm anxious to see your book, or let me know when it comes out.
I definitely will.
Far enough along on it, or?
Yeah, no, I submitted it to, well, let me end the recording, but yeah, it's available on Amazon real soon, but I will let everybody know.
Yeah,
on that note, yeah, hold on, Bob, 1 sec. I'll say bye to everybody. Bye, everybody. And then we'll keep talking.